Every time the stock market crashes, the same pattern appears. News headlines turn negative, investors become nervous, and millions of people begin asking the same question. Should I sell before things get worse? For many households, market crashes feel like financial disasters. Retirement accounts shrink, investment portfolios lose value, and the uncertainty creates a deep sense of anxiety. Because when people see their savings falling, the instinct is simple. Protect what remains. Move to safety. Wait for stability. But behind the scenes, something very different is happening. While many people are trying to protect themselves from losses, another group of investors is quietly doing the opposite.
They are buying, not cautiously, not slowly, but aggressively. For them, market crashes are not disasters, they are opportunities. In fact, many of the wealthiest investors in the world have built large portions of their fortunes during periods of market panic. And this creates an interesting question. Why would anyone welcome a market crash? Why would sophisticated investors move toward risk precisely when everyone else is trying to escape it? The answer has very little to do with courage or intelligence, and it's not simply about having better investment strategies. The real explanation lies in something deeper. It's about financial structure. Because the way wealthy investors structure their finances gives them a powerful advantage during periods of volatility, an advantage that most households simply don't have. While many investors are forced into defensive decisions during market downturns, wealthy investors often have the liquidity, patience, and margin to act strategically, and that difference changes everything. In this video, we're going to break down why market crashes often benefit wealthy investors the most. We'll explore the structural reasons behind this pattern, the psychological pressure that affects everyday investors, and the hidden financial mechanics that turn market volatility into opportunity for those who are prepared. And by the end of this video, you'll see why the phrase "buy the dip" is much easier to say than it is to actually do. So stay with me until the end, because the final section explains the structural shift that allows some investors to take advantage of market crashes, while others are forced to simply endure them. And if you enjoy calm, analytical explanations about how money systems actually work, consider liking the video and subscribing to Kane Invests. Because on this channel, we focus on understanding the structure behind financial outcomes. Not hype, not shortcuts, but the systems that shape wealth over time. To understand why market crashes affect people differently, consider someone like Aaron. Aaron is 38 years old and lives in Denver, Colorado. He works as a senior IT specialist at a mid-sized healthcare company and earns about $92,000 per year. After taxes, healthcare deductions, and retirement contributions, his take-home pay is roughly $5,200 per month. Aaron has been investing for several years. He contributes regularly to his 401k through his employer and also puts some money into a brokerage account when he can. By most standards, Aaron is financially responsible, but his financial structure looks like this. Mortgage payment, $2,100 per month. Car payment, $540. Car insurance, $180. Student loan payment, $350. Groceries and food, $650. Utilities and internet, $240. Health-related costs, $200. Gas and transportation, $260. Phone and subscriptions, $130. That brings Aaron's regular monthly expenses to roughly $4,650, which means that in a typical month, Aaron has about $550 of financial margin. On paper, this seems reasonable. Aaron is contributing to retirement, he has about $9,000 in savings as an emergency fund, and over the years, he has accumulated around $85,000 in investment accounts between his 401k and brokerage account. But then a major market downturn occurs. Imagine the stock market suddenly falls 25% over several months. Aaron checks his investment accounts. His portfolio, which was worth $85,000, now shows closer to $63,000. That's a loss of more than $20,000 on paper. Even though Aaron understands that markets fluctuate, seeing that number drop creates real psychological pressure. And at the same time, life continues. Mortgage payments still arrive every month, car payments don't pause, groceries, insurance, and daily expenses continue as usual. Aaron knows that the common advice during market crashes is to buy the dip. But here's the problem. Aaron's financial structure leaves him with only a few $100s of margin each month. His emergency fund exists primarily to protect against job loss or unexpected expenses. Using it to buy stocks during a crash feels risky, because if something goes wrong, a medical issue, job disruption, or major repair, that safety cushion disappears. So Aaron does what most financially responsible households do. He continues his normal retirement contributions and waits for the market to recover. But he doesn't have the financial flexibility to invest aggressively during the downturn. Meanwhile, something very different is happening in another part of the market. Because while investors like like Aaron are cautiously waiting for stability, some investors are actively buying large amounts of assets at discounted prices. And the reason they can do this has very little to do with courage. It has everything to do with psychology and financial pressure during uncertainty. Market crashes don't just affect portfolios, they affect how people think. Because when the value of investments begins to fall, the experience feels very different from normal market fluctuations. During stable periods, investing feels logical. People talk about long-term growth. They discuss diversification. They repeat familiar advice like stay invested or buy the dip. But when markets actually start falling, sometimes rapidly, the emotional environment changes. For someone like Aaron, opening his investment account and seeing $20,000 disappear on paper triggers a natural psychological response. Behavioral economists call this loss aversion. Loss aversion is the tendency for people to feel losses more intensely than gains. In simple terms, losing $20,000 hurts much more than gaining $20,000 feels good. This psychological bias has a powerful effect on investor behavior. Instead of calmly viewing the downturn as a long-term opportunity, many investors begin focusing on protecting what remains. Questions start appearing. What if the market keeps falling? What if this turns into a recession?
Should I move my money somewhere safer?
Even investors who understand long-term investing can begin to feel uncertain, and this uncertainty becomes stronger when financial systems already feel tight. Remember Aaron's financial structure. His monthly expenses already absorb most of his income. His emergency fund exists to protect against unexpected events. So when the market falls sharply, Aaron is dealing with two types of pressure at the same time. First, he sees his investments losing value. Second, he knows that his financial stability depends on maintaining his safety cushion. This combination often leads to a very common behavior during market crashes. People stop investing. They pause contributions. Some investors even sell their investments to reduce stress and uncertainty. From a psychological perspective, this behavior makes sense. Selling stops the emotional pain of watching losses grow. It creates a sense of control. But from a financial perspective, this is often the exact opposite of what long-term investors should do. Because historically, some of the best long-term investment opportunities appear during periods of panic. Prices fall not just because companies suddenly become worthless, but because fear spreads quickly through financial markets. Assets that were considered fairly valued months earlier can suddenly become deeply discounted. But taking advantage of those opportunities requires something very specific. It requires the ability to act without fear of immediate financial consequences. And that ability depends on one critical factor: liquidity. Liquidity determines whether an investor can act during uncertainty or whether they must simply wait for stability to return. Which leads to one of the most important differences between average investors and wealthy investors during market crashes. Because while many investors are psychologically and financially constrained during downturns, wealthy investors often have the freedom to move in the opposite direction. And that freedom creates one of the most powerful advantages in investing. When the market crashes, most investors focus on the losses they see on their screen. But the more important story is often about what people are unable to do during those moments. Because when markets fall sharply, something unusual happens. Assets across the entire financial system become cheaper. Stocks decline. Real estate slows down. Private investments become easier to negotiate. Companies that were expensive months earlier suddenly trade at large discounts. In theory, this environment should be one of the best times to invest, but for many households, the opportunity exists only in theory. Let's go back to Aaron. When the market drops 25%, Aaron understands that prices are lower. He knows that long-term investors often benefit from buying during downturns, but his financial structure limits what he can actually do. His emergency fund exists to protect him from financial shocks. Using that money to buy stocks during a volatile market would reduce his safety cushion. And if something unexpected happens, a job disruption, medical bill, or home repair, that decision could create real financial stress. So even though the opportunity exists, Aaron has to remain cautious. He continues his normal contributions, but he cannot allocate large amounts of capital during the downturn. Now imagine another investor, someone with significantly higher liquidity. Instead of having a few $1,000s in emergency savings, this investor might have hundreds of thousands or even millions of dollars in available capital. Their daily lifestyle does not depend on the performance of their investments. Their financial system contains large buffers, which means when markets decline, they are not forced into defensive decisions. They can move in the opposite direction. Instead of worrying about survival, they can focus on allocation. They can purchase assets when prices are depressed. They can negotiate favorable terms in private investments. They can buy shares in companies that temporarily fall below their long-term value. And this is where opportunity cost becomes important. When people lack liquidity, they don't just lose money during downturns. They lose the ability to act during opportunity. Over time, this difference compounds. Two investors might participate in the same market for decades, but the investor with liquidity during downturns accumulates assets at lower prices. The investor without liquidity simply waits for markets to recover. And this pattern repeats across many economic cycles. Every recession, every correction, every financial crisis. Periods of market stress often become periods of asset accumulation for those with available capital. But for many households, market downturns feel like something to survive rather than something to take advantage of, which leads to another structural issue. Because when financial systems operate with limited margin, even small disruptions can make market downturns feel far more dangerous than they actually are. And this is where financial fragility begins to reveal itself. Market crashes do more than reduce asset prices. They expose the strength or weakness of financial systems. During stable economic periods, most financial structures appear to function normally. Jobs are steady, markets are rising, credit is easily available, and many households feel relatively comfortable. But when markets decline and economic uncertainty increases, hidden weaknesses begin to appear. This is what economists often refer to as financial fragility. A system may appear stable under normal conditions, but it becomes extremely vulnerable when pressure increases. Let's go back to Aaron. Under normal market conditions, Aaron's finances seem manageable. His income covers his expenses. He contributes to retirement. He maintains an emergency fund. But a major market downturn rarely happens in isolation. Market crashes are often connected to broader economic stress. Companies begin reducing hiring. Some industries slow down. Layoffs increase. And suddenly, the stability that households rely on begins to feel less certain. For Aaron, this changes the entire financial equation. When the economy becomes unstable, protecting liquidity becomes more important than pursuing investment opportunities. Instead of thinking about buying discounted assets, Aaron starts focusing on risk management. He may increase savings, delay large purchases, pause additional investments. From a financial survival perspective, these are completely rational decisions, but they also reveal a structural limitation. Aaron's financial system does not have enough margin to comfortably absorb large economic shocks while also taking advantage of opportunities. And this situation is extremely common. Many middle-class households operate with financial structures where most of their income is already committed. Mortgage payments, car loans, insurance premiums, student loans, utilities, and daily expenses. These fixed costs create a rigid financial system. When income remains stable, the system works. But when economic volatility appears, flexibility disappears. Now imagine a different type of financial system. One where fixed costs represent a much smaller percentage of total income, where large cash reserves exist, where investments are diversified across multiple asset classes. In these systems, market volatility does not threaten survival. It creates strategic opportunity. This is one of the quiet differences between financially fragile systems and financially resilient systems. Fragile systems react defensively to shocks. Resilient systems can absorb shocks and act strategically. And over long periods of time, that difference can significantly influence wealth accumulation. Which brings us to the final part of this discussion. Because the real lesson behind market crashes is not simply about buying stocks during downturns. It's about understanding the financial structure that allows investors to act when opportunity appears. If market crashes often create opportunities, the obvious question becomes, why are wealthy investors able to benefit from them while many others cannot? The answer is not simply better stock picking. It's not superior predictions about the market, and it's rarely about perfect timing. The real difference lies in how their financial systems are built long before a crash ever happens. Because wealthy investors don't prepare for market crashes during the crash. They prepare for them years in advance. And the preparation usually revolves around three structural principles: liquidity, margin, and patience. First, liquidity. Many wealthy investors maintain large pools of accessible capital. This might be in the form of cash reserves, short-term treasury investments, or liquid funds that can be deployed quickly. The purpose of this capital is not always immediate return. Instead, it acts as strategic flexibility. When markets are stable and asset prices are high, liquidity may appear inefficient. Cash earns less than stocks during bull markets, but during market crashes, liquidity becomes extremely valuable because it allows investors to purchase assets when others are forced to sell. The second structural advantage is financial margin. Wealthy households often operate with far lower financial pressure relative to their income. Their core lifestyle expenses represent a small portion of their overall financial resources, which means their day-to-day life does not depend on market performance. When markets decline, they are not forced into defensive behavior. They can wait, they can analyze, they can deploy capital gradually. And this leads to the third advantage: patience. Patience is often misunderstood in investing. It's not simply emotional discipline. It's a structural ability to
wait without financial pressure. Investors who rely heavily on short-term financial stability often cannot afford to wait through long periods of uncertainty. But investors with large buffers can think in decades instead of months. This changes how they view market crashes. Instead of seeing falling prices as danger, they often see them as discounted future returns. A stock that falls 30% during panic may represent a long-term opportunity if the underlying business remains strong. A real estate market slowdown may allow investors to negotiate better deals. Entire sectors of the economy can temporarily trade below their long-term value during periods of fear, but recognizing these opportunities is only part of the equation. The ability to act depends on having capital available when others do not. And this is why market crashes often accelerate wealth inequality. Investors with liquidity accumulate assets during downturns. Investors without liquidity simply wait for recovery. Over multiple economic cycles, this difference compounds. More assets are acquired during periods of stress. Those assets grow during periods of expansion, and the cycle continues, which leads to an important conclusion. Market crashes themselves do not automatically create wealth, but they often create the conditions where wealth can be built faster for those who are financially prepared. And preparation does not begin when markets fall. It begins with building financial systems that prioritize margin, liquidity, and resilience long before volatility appears. Because once a crisis arrives, the opportunity is already underway. If you found this breakdown helpful and you enjoy calm, analytical explanations about how financial systems actually work, consider liking the video and subscribe to Kane Invests, because on this channel we focus on understanding the structure behind money, markets, and long-term wealth. Not hype, not shortcuts, just the systems that quietly shape financial outcomes over time.